Investing Lesson 1, Investing Basics. In this lesson, you'll learn some of the basic level investing terminology that you'll need to know in order to understand the rest of this module.
Saving money and investing money have a lot of similarities, but they're also very different. They're both things that you need to be good at throughout your life. The better you understand how to save money and how to use your money to make money by investing it, the more financial stability and success you'll have. The biggest difference between saving money and investing money is that the money that you put away for savings is easy to access because you keep it in a bank account. The money that you invest takes time to grow and isn't easy to access. Bank accounts are safe. Each account that you have is insured by either the FDIC, known as the Federal Deposit Insurance Corporation, or the NCUA, which is known as the National Credit Union Administration, for up to $250,000 per account. So here's the problem with SAFE. SAFE doesn't make you any money. As a matter of fact, SAFE means that you're losing money because you aren't keeping up with inflation. Even the best savings accounts and high-yield savings accounts interest rates don't keep up with inflation. If you want your money to grow over time, you have to invest. But all investments come with risk, and they aren't insured by either the FDIC or the NCUA. You have a lot of opportunity to make money, but you can also lose money as well. As we progress through the investing module, you're going to hear a lot of terms that are probably new to you and might sound like a foreign language if you're not aware of what they mean. So we're going to start off by covering some basic investing terms. That way you have a baseline understanding of the lingo that people use when they're talking about investing. Starting at the most basic level, a contribution is the money that you contribute to a retirement plan and is typically pulled from your paycheck or a bank account. A stock is a share of ownership in a single company. Stocks are purchased for a share price which can range from pennies to a couple thousands of dollars depending on the company. Examples of stocks are Tesla, Apple, Amazon, Google, and Disney. A bond is a loan to a company or a government entity, which agrees to pay you back in a certain number of years. In exchange for the loan, you're earning interest. Bonds are typically less risky than stocks because you know exactly when you'll be paid back and how much money you're going to earn in interest. They typically have lower long-term returns. A mutual fund is a mix of investments that are all packaged together. Mutual funds allow investors to skip the work of picking individual stocks and bonds and instead purchase a diverse collection that are actively managed by a professional. The diverse collection of stocks and bonds make mutual funds generally less risky than individual stocks, but they often come with high management fees. Index funds are a type of mutual fund that automatically follow the performance of a specific stock market index. The S&P 500 is a stock market index that tracks the performance of the top 500 companies in America. Index funds eliminate professional management and charge lower fees than actively managed mutual funds. Similar to a mutual fund, an exchange-traded fund is a bunch of individual investments all bundled together. The difference is that ETFs trade throughout the day like a stock and are purchased for a share price. ETFs are a good option for new investors or small budgets because their share price is usually lower than the minimum investment required for a mutual fund. The Dow Jones tracks the stock price of 30 large U.S. companies from all major sectors, with the exception of utilities and transportation. The Dow's performance is widely considered a key indicator of the health of the entire U.S. economy. The New York Stock Exchange is one of the largest marketplaces in the world for investors to buy and sell shares of stock. The easiest way to buy stocks on the New York Stock Exchange is through an online stockbroker. Trading hours are from 9:30 a.m. to 4 p.m. Eastern Standard Time. NASDAQ is the second largest marketplace in the world where more than 3,000 companies can list their shares of stock. Investors can buy and sell stocks through their stock brokers. Thousands of stocks, including some of the world's largest companies like Amazon, Google, and Microsoft, are listed on NASDAQ. A brokerage account is an account that you sign up for through a brokerage company. You can add funds to your account and then buy and sell different investments such as stocks, bonds, mutual funds, and ETFs. The brokerage company acts as a middleman between you and the investment that you want to purchase. Another way of putting it is that the broker connects the seller and the buyer to help them make a transaction. This isn't a free service. Brokerages do charge a fee. We'll go over that more in detail later in this module. A bull market is when the stock market is going up and people are confident it'll keep going up for months or years. A bear market is when the stock market is failing and investors are unsure of how bad things will get. Assets are things that make you money. Liabilities are things that cost you money. A portfolio is everything you own, from stocks and bonds to cryptocurrency to real estate. A portfolio is a snapshot of all of the assets that you own. Dividends are a portion of a company's profits that they pay out to their shareholders on a quarterly or yearly basis. Companies are not required to give dividends to their shareholders, but a lot do. These are just some of the most common terms you'll come across when you start investing. There's a lot more to it than this, but we don't want to overwhelm you with too much all at once. As you progress through this module, your knowledge base will expand, which should help you become more comfortable as you think about investing in yourself and in your future. In the next lesson, you'll learn about compound interest and why investing at a young age is so important.